Hello everybody, in this video we'll be beginning with the chapter number 10 of CMT level 1, Introduction to Volume Analysis. In case you wish to watch the previous chapters, you can check the description box below. I've linked the playlist and it contains all the chapters of CMT level 1. So this is a pretty short chapter because we are just getting introduced to volume analysis. Even before starting this chapter, we have already discussed few concepts of volume in the previous chapters. We saw that every time we trade a breakout or a breakdown, we always confirm it with the volumes, right? So in this chapter, we'll be just going ahead and we'll study volume analysis, and this is going to give you an overview. Let me tell you what are the learning objectives. First, we'll be able to define volume, and then we'll also be studying about open interest. Then we'll define the terms related to volumes. We'll describe how volume provides information on liquidity and the participation. Market participation and liquidity is something which we can see using the volumes, and describe how volume adds the perspective to price action. So these are the few concepts, these are my learning objectives. So let me start with the chapter. So I'll just use the PDF of the Wiley's textbook since it's a very tiny chapter. So here's a quote by Joseph Granville which says, "Volume is the steam in the boiler that makes the choo-choo go down the tracks." Okay, so even the most casual investor knows what matters about a stock: price. We have been studying about this over and over again. The most important aspect of a stock is its price. The price basically reflects every single thing about the stock, right? Even if there's a good news in the market or a bad news in a market or there's some insider news, no matter what, everything at the end is reflected in the price itself. So that is what they are saying. Price surely matters, but this is a market. Waiting for the final number on a given day or week will tell you what happened, but not why, or more important, how. So picture a mall parking lot. Is it full or half empty? Is it Saturday or a weekday? How many people are walking the shops and sitting in the restaurants? Regardless of what they buy or how much they pay, what matters to investors in the mall is that customers are showing up and participating. To a smart trader, that's innately understood as volume. So volume is basically what is the perseverance of the investors, right? So what is the, how much are people interested in it? That is something which we are going to see. Yes, it has high, yes, the price gave a breakout, but are the people really interested to work on it? Is it having some good kind of, people, are the people really very much interested to participate in it? So that is something which we'll see. Now when you confirm stuff with a breakout, what really happens is that you will not fall in the trap of false breakouts, right? So you will be able to only trade in those stocks, in those breakouts where the volume is also considerably high. That is going to give you a double. So one can track volume for just about any stock or index or futures market easily enough, but understanding it and using it to one's advantage is a skill. In this chapter, we are basically introducing basic definitions of volume analysis. So from there, we begin breaking down the principal concepts behind volume analysis. As a technical analyst, you will be expected to understand how and why volume is an important piece of data. So these are the various terms which you need to learn, because these terms can be tested in your exam, and besides your exam, these terms will also help you become a better technical analyst. So first, let's see what is a market volume or a trading volume. So a market volume or a trading volume is just the number of shares or the contracts that are exchanged between buyers and sellers during a given time period. Okay, so in a particular time period, how many number of shares or contracts are exchanged between the buyers or the sellers. If you go on your NSE website and if you go on market data, let me check where I can find it. Just a second. volume. Now look at this. You can get a volume spurt, volume sports, volume. So you can get so many things on the NSE website if you're trading in India. Just go here and you can see everything. Okay. And if you go to market data, and you can actually see the volumes here. If I want to see the derivatives, I can click on derivatives. So just type volume total, whatever you want to find. For example, right now let's just find market volume or trading volume of NSE. When I just type this, I get this volume gainers. Look at this. So any information which you want, that will all be there. Look at the volume over here today. So this is a period of time we are talking about. If you see this today over here, so these are the number of shares which have been exchanged between the buyers and the sellers in today in this particular stock. So that's with my total volume. Sorry, that's with my market volume or trading volume. Now let's come to what is a total volume or exchange volume. The volume of all issues traded on an exchange such as New York Stock Exchange. Again, when you talk about total volume or exchange volume, you are talking about the volume of the exchange itself. That is the volume of the entire market or the entire stock exchange itself. What is the volume of it? Fine. Now what is total trades? Total trades is the number of transactions recorded during a given period of time. So regardless of the volume, the number of transactions that took place, that is my total trades. Now I have something known as the tick volume. The intraday sum of volume on a per transaction basis. In other words, the total volume exchanged intraday during a specific number of ticks. So ticks is basically the transaction. So this is the transaction volume. Now we have open interest or OI. This is very much used in your stock market. If you go on your NSE and if you go on market data, if I go to derivatives market, look at this. So these are my index options, Bank Nifty, Nifty, can you see, of various strike prices. If you look at this, the open interest is given over here. So this column is showing you the open interest on this specific strike price. What is open interest really? So open interest is basically the outstanding contracts. What do I mean by outstanding contracts? Outstanding contracts are the contracts which haven't been settled or closed as yet. So the number of open, so these transactions are open, they haven't been closed yet. Open futures or option contracts. Open interest is technically not a volume statistic, but it is a companion statistic in the analysis of futures and options. Now we have something known as the upside volume. What is the upside volume? The volume traded on upticks. So upside volume is when the opening price is, when the closing price is more than the opening price, right? So upside volume is basically the volume on the stocks which have traded upwards or which have traded on upticks. The opposite is the downside volume. Downside volume basically talks about those stocks where your opening price is more than your closing price. So these are downticks, right? So the volume traded on downticks, presumed to be from the supply side. Supply side is sellers and demand side is buyers. Now we come to what is my index volume. Index. Now when we're talking about index, we are talking about Nifty 50 or SP zone. So we are talking about the indices, right? So the sum of the volume traded in all components of an index. If I'm talking about Nifty 50, the volume of the entire 50 stocks. Now we come to what is a dollar volume. Dollar volume. So as you know, the dollar is the king currency, right? Almost every single thing is compared to the dollar index. So if you think about the commodities market, it's often seen that the metal prices are inversely related to the dollar index. When the dollar strength is going up, then my metal prices go down. That is a common assumption, right? So every single thing is very somewhere or the other closely related to the dollar volume. So what is dollar volume? It is the value of shares traded during a given time period. So when I say value of shares, it is the number of shares multiplied by the price, which is giving you the value of the shares. That is known as my dollar volume. What is capital weighted volume? Capital weighted volume is basically index or exchange volume weighted according to capital weights of the index components. So in capital weighted volume, what really happens is that the capital weight of the index is given. Okay. Float. Now, what is float? This is a very important concept. So when you are trading in shares, when you are as a listed company, you are going to give to the market participants some shares to trade, right? Few of the shares are kept with the owners, few of the shares are kept with the promoters itself, and the rest of the shares are led freely to float in the market where people like you and me can invest. But the other shares are kept with the promoters itself. So the free shares in which the public can trade, that is known as a float. Average volume or typical volume. So what is average volume or a typical volume? Let's talk about that. A moving average of volume that smooths the peaks and valleys to show a more representative view of trading activity over time. Average volume is extremely important. It allows technicians to discern whether volume is increasing or decreasing relative to the past. So average of volume, you know what is average, and you know how to calculate simple moving average. We saw that in the previous chapter. So average volume is again the average of the volume. It is also known as the typical volume. I hope these concepts are clear. What is market volume, what is total volume, total trades, tick volume, open interest, all of these. Fine? Okay. So now, why is volume analysis important in the first place? Why do I have to take in consideration the volume? Why can't I just, why can't I just trust my indicators, and why can't I just look at the price without combining it with volume? A trade produces only two pieces of information, the price, and the price is oft neglected sibling, which is volume. See, these are the only things which are there. So if you only have to see two things, you need to see both of them, right? Perhaps the least appreciated piece of puzzle, volume represents fertile ground for technical analysis. Proficiency in volume analysis is a rare skill. So that's the difference between mediocre traders and exceptional traders. Mediocre traders often ignore the volume, whereas the very good big traders, they always combine trading with the price as well as the volume. So Benjamin Graham is the father of value investing and a mentor to Warren Buffett. I hope you know who is Benjamin Graham. He wrote a very famous book, which is one of my favorite. I'm not going to tell you the name, you can guess it. So the volume is the ballot box. Volume is the literal illustration of the forces of supply and demand. Let me say something. Let me tell you something. If I have a business of producing milk and I sell milk in the market, and randomly I'm increasing the price, randomly, there is no reason for it, for no reason I'm just increasing my price, so everyone will get to know that I've increased the price, right? But will people keep buying from me if the price is, I just increase the price for no reason? Do you think you will come and buy from me? No. Maybe for few days you will buy, but after that you will stop buying from me, because you will be like, why is she selling it for that much money? And after few days nobody is going to buy from me, so because of that I will again reduce my prices to how it was previously. You look, that is a flaw, right? That I increased the price for no reason, but then people were not ready to buy, so the demand was not that much, so people weren't buying from me only. Now let's see another situation. In the market there is a scarcity of milk, okay? So the milk is not available so easily, and so many buyers want to buy milk, so you all are giving so much demand for milk and so many people want to buy milk. Now I am reducing the price. When I'm reducing the price, I also have a huge demand of people who want to buy milk from me, so I am increasing the price. At the same time, there are a lot of buyers who are ready to pay me this money, and there's a lot of demand as well. What will happen in this case? It will work for me. I'll keep selling, the price will go further up because the demand is increasing. So did you see the difference between both the situations? In one situation the volume was less, people were not interested to buy. In the second, the demand was high, the volume was high, so the price went up. So similarly, if you relate that to the stock market, sometimes the price goes up without any reason. In such situations, you should avoid. But if the volume is confirming, then you should get into the trade. Okay? Volume validates price. So this is what I tried to discuss with the example which I told you guys, that price needs some validation. Price is the most important aspect, 100% I agree. Price action is supreme. But you need to always confirm it with the volume and see if the demand and supply is also in the favorable situation. Volume is the quantity of shares or contracts traded. But here is the key. The more shares exchanged at a given price, the more volume confirms price. More traders vote in parlance of Graham that the price at the point in time. In the same way, a low volume tells a different story. If fewer investors participate at a given price point, then it's not valid. So I have explained that to you, right? The same principle applies to trading volume. The more people participating in the price movement, the more price movement is validated. For technical traders, volume dictates quality of the price. Okay. So the next thing is volume liberates liquidity. If more and more investors are participating in a particular instrument, that will show me that there is liquidity, right? If people are not interested only, if people are not interested to buy or sell anything in this market, in this instrument, then there is no liquidity. I might not be able to place a sell order of my shares and I might be stuck. If you can go on your trading view and if you look at some stocks, they're very illiquid in nature. Some of the stocks are very, very illiquid. Their charts are also hollow. So those are the kind of stocks where there is no volume. So you must avoid trading in such stocks. Okay. So you understood what volume liberates liquidity means. If the volume is low, the odds of quickly selling a large block at a good price are not very high at all. Okay. Now we have volume substantiates information. What does that mean? Whenever a new information comes in the news, or when there's a new information, it can be anything. All that is reflected in your volume. How is it reflected in your volume? As the volume rises, it equates to more emphasis being placed upon the new information by investors. Similarly, news or information that does not greatly impact volume would indicate that the information has little significance to the market. So the new facts or the new news and all of that which comes into the picture, those are the things which will be seen in the volume as well. The moment, let's say, Reliance got its quarterly results and they're very good, just an example. Now everybody's going to start acting on it and there will be a high volume of buying. So that is what I'm saying, that volume substantiates information. Volume reveals conviction. I've already explained this to you, that volume is going to show you what is the conviction of the buyers, what is the convictions of the investors, how much interest are people showing in this, right? So the volume of the shares often reveals the market's true conviction. For example, you hear that a renowned investor has bought a certain stock. So upon learning it, you will buy 1,000 more. So it's like that. Volume expresses interest and enthusiasm. I explained this to you. Shows the interest of the buyer, shows the enthusiasm of the buyers. Volume denotes the disparity of opinions. What is disparity of opinions? Difference in opinions. So volume is also going to show you a difference in opinions. Often information and commentary in the media lead the investing public to choose sides, regardless of the underlying facts. Trading activity expressed as volume is the empirical evidence that the diverging opinions at work, with each side betting in their own beliefs. The greater the disparity of opinion, the greater return each side expects. Thus, a wide divergence in those beliefs shows up a higher volume. See, higher volumes are usually created by HNIs and institutional investors. If people like you and me, retail investors, basically look at the news and trade, then you and I buying 10 shares, 20 shares, 100 shares, 1000 shares will not make any difference in the volume. So volume difference will be made by huge amount, huge capital. So volume is the fuel of the market. So it is literally the fuel for the price. You need volume for the price. If you want a healthy rally, you want a healthy uptrend, then the volume should keep fueling it. If the volume is not fueling it, then the uptrend is going to subside very soon. Volume exposes the truth. So how does it expose the truth? It shows you what is the real interest. Volume gives rise to velocity. So market volume is a quantity that when increased tends to produce an acceleration in the price direction. This is again price movement. The speed is also given by volume. So that's about it about our introduction to volume. In the further chapters we'll be discussing the volume indicators as well. Make sure to read this chapter by yourself, and also you can check the NSE website and just go through the different things which are given about the volume, so that will help you understand better. Thank you.